Welcome everyone, another episode of Financial 15. Kevin and I are ready to go, and today we're providing some tips on your tax-free savings account, particularly three mistakes you want to avoid with that TFSA. You're going to want to stick around.
Yeah, again, we are here back with another Financial 15. We are going to talk about a few different topics today, specifically 1, 2, and 3 mistakes. Now, if you want to find any of our other videos that we've got on TFSAs, RSPs, anything else we've done, please go to our website at beckerorr.com or go and like us on Facebook or visit our YouTube channel, become a regular subscriber. You'll get this on a regular basis. Much needed information all the time. Anyways, Clint, to start us off, TFSAs, not everything is simple with them. There are mistakes that you need to avoid, isn't there?
There are a couple here, and we're trying to find common mistakes we encounter, which we think can improve the situation for folks. We'll go over the top 3 in our view. And the first one here has to do with how do you designate a beneficiary? There's some new terminology when it comes to TFSAs. There's a successor holder, a successor annuitant versus a beneficiary. It can get a little confusing, and that's the first mistake to avoid. You want to make sure you get the designation correct. And we'll go through a quick example here, Kevin. I'll pull this up. Who pays the tax? How does it all work with the TFSA?
Yeah, I mean, basically, depending on what it is, you can either have a beneficiary or a successor holder. Some people refer to it again also as a successor annuitant. But again, the thing to remember is the spousal holder is the one that has to have the successor annuitant on it. It can only be a spouse or a common law partner. And the rationale for why you want to do this is to avoid any sort of a tax scenario. So if the spouse is named as beneficiary, the tax deferral option still exists and can make exempt contributions to the TFSA. What we mean by that is if you've maxed out your TFSA, if your spouse has maxed out hers, if something happens to you, your entire TFSA can roll into her TFSA without any tax consequences. Even though even though she's maxed hers out, you can add that. That is a big factor that you want to have there as opposed to designating as a beneficiary. Anyone else listed, of course, they'll receive the TFSA, but they cannot automatically put that into theirs. That's a big event, and it is huge when it comes to taxes. But there's more to it than that, isn't there?
Yeah, we'll go through a quick example here. So you have that special term, successor holder, successor annuitant, sometimes it's called, but can only be used for a spouse, and then everyone else has to be listed as a beneficiary. And we'll see here, we'll flesh out what Kevin just talked about, why that makes a difference. So you can see the first example, a spousal rollover. We're assuming now we're using that special term, that successor holder term for our spouse. They're named as such on the TFSA. We'll assume there's $50,000 in the TFSA at the day of passing. The full value goes to the spouse. It just moves right in regardless of my spouse's contribution. They can be maxed right out. It'll still just get added to their TFSA. It's a simple rollover there. Not the case if you list someone as a beneficiary. So the details here do matter. If you list someone as a beneficiary and there's $50,000 in the TFSA as the day of passing, there's no tax, but they get a check. Here's $50,000. Do with it what you'd like. Now, they can turn around and put it into their TFSA, assuming they have the room. If they don't, they will not be able to add that money to the TFSA. So they essentially get a check, and they'll have to do with it whatever they want to after that. So there is some details there that are different depending on how you list that beneficiary, whether you use the term beneficiary or whether you use the term successor holder. And the last bit here, Kevin, just to be complete, we'll have to mention this. What happens when someone passes away? Let's say there's $50,000 in the account at the day of passing, but it's not immediate. It takes some time. Got to do some paperwork. And by the time that account actually moves over, it's now worth, say, $52,000. You've had a little bit of growth from the day of death to the day where you actually get the rollover. If you use that first term, that successor holder, spousal rollover, it does not matter. It all just rolls right over into the other TFSA, the spouse's TFSA. If you use the beneficiary, that extra little bit of growth after the day of passing is actually taxable and taxable as income to the beneficiary. So that first mistake, make sure you get the term correct, whether it's a beneficiary or the successor holder. You want to be diligent and use it correctly. Is there anything you want to add?
Yeah, no, I think that the biggest factor to remember is that even though successor annuitant can go only to a spouse, if you do name your spouse as beneficiary, everything we just listed under beneficiary happens. It will not roll over to her. So make sure that spouse is listed as successor holder or successor annuitant. Those are important points to make sure you have that differential. Just because it's a spouse does not mean that it's automatically listed that way.
Roll us into mistake number 2 here, Kevin.
Yes, mistake number 2 is using your TFSA for a savings account. Remember, the TFSA is not, even though it is said to be a tax-free savings account, It is more of a tax-free investment account. This is more of a misnomer than anything else. And the rationale is you don't want to just put money in there, leave it in cash, and save it for a rainy day. If you're going to do that, that's what the bank account or the savings account is for. This is more or less to try and put money away so that you can either utilize it further down the road for major purchases, vacations, whatever the case may be, or just to save it until you get to retirement. But that's money that you can invest. So leaving it just as a savings account is not what you want to do, because there's the big options that come with withdrawals and deposits that we'll get to later. But this is not what it's meant for as its purpose. It's meant more as an investment savings account as opposed to just saving for everyday scenarios.
Exactly. And I think part of it is the financial world here is to blame. Because I remember in 2009 when the TFSA was created, suddenly all the banks and credit unions, they would start to list TFSA rates, which are really just a GIC rate that you could put into the TFSA, but it made it seem as if the TFSA was some kind of special savings account with its own rate of return. And really, it's a pretty wide open, flexible investment account. You can put stocks in there, you can put alternative investments, real estate. There's a lot of options that can go into that TFSA. But the financial world initially in that 09 period, they'd give you like the GIC rates, and then they'd give you the TFSA rates, were really just the GIC rates under a TFSA label. It wasn't any different. But that contributed to the confusion in my view. But I agree. You've only got so much room in that TFSA. You want to get the most bang for your tax-free dollar, so use it for investments. The third mistake here, third option you want to avoid has to do with the withdrawals. We'll go through some of the rules here, but the idea being if you can plan your withdrawals, not always possible, but if you can plan the withdrawals, it can be to your benefit. So first thing, Kevin, we have to understand the withdrawals. You can take the money out really much whenever you want. There's really no restriction there.
Yeah, no, there isn't. I mean, any money that you have in there. So as your examples have had before, if you had 50 grand in there and you want to take out 10, take out 10. If you want to take out 3 later, take it out. You can withdraw as much as you want any time you want over the course of a year. That's never the big problem. But it's when the withdrawals are added back to the TFSA contribution room, that's the big problem. So if you had 50 grand in there and you took 50 grand out that year, that 50 grand cannot go back in the same year. The government, if you do, will tax you on it. They want to make sure of that. So you have to make sure that you're planning these carefully. So taking out in January, you're basically restricted till the following January. But if you take out in December, that's a completely different situation. So there are rules that apply to this and when you should and shouldn't, is there?
Absolutely. It's because they use the calendar year. And that's really the key here when we talk about planning for the withdrawal. It's using that calendar year framework, because you take the money out in, say, October, the next calendar year, which is only a few months away, starting in January, you get all that contribution room back. So the example here, let's assume there's an individual named Bob. They got 50 grand in their TFSA, and they know that in February, they're going to need $10,000. So if they take it out in February, they now have to wait until the following calendar year, the following January, before they're allowed to put that money back in. But if Bob knew in advance, you know what, I need 10 grand in February, he could take it out a little early, could take it out in December, couple months early, but the key here is that's in a different calendar year. So he takes it out in December, fast forward 1 month to January, it's a new calendar year. He now has the ability to put that money back in if he can. Or if later in the year, let's say he takes the money out in December, and then he spends the 10 grand, but he comes into some money in March or comes into some money in June, whatever it happens to be, he has that full room now available to him because he did the withdrawal in the prior calendar year. So when planning withdrawals, keep that calendar year in mind. And if possible, try to take it out near the end of the calendar year, because that way you'll get the money and the room, back quite quickly.
Yeah, and that's right. And again, we must remember that the examples we're dealing with is money that you already have in there. Taking it out, you can't put the same sort of money back in. Now, in this example here, I mean, as of 2021, you have 75,500 worth of room. If you only had 50 in there, if you took 10 out, theoretically, you could put 10 more in, but that's 10 more of new contribution room. You're not really replacing the 10 grand you took out because you still haven't hit your maximum level. So it is important to know where you are on that scale for how much you've contributed over the number of years as to when you can withdraw. But as we've said, this is the basic rules of thumb. If you've taken it out, don't worry about contributing it until, again, the next year that it comes out. And again, the next calendar year, not the year you took it out, but the calendar year start. That's important because a lot of people figure, well, I took it out in October. Well, I can't put it until next October. No, if you take it out in October, you can put it back in January. But if you take it out in January, you can't take it out till the following January. So those are important points to know. So again, these are sort of 3 pitfall mistakes that we've had common questions on. And things that you should need to know about going forward. If you have more questions on the TFSA in specific or in investments or anything along those lines, please visit us, chat with Clinton and Kevin down below as we've got listed there. We are more than happy to answer your questions on this, on any more TFSA mistakes that you could have, or if there's any other topics you want to deal with. Otherwise, this is a good start for anybody that wants to try and avoid and maximize what they can with their TFSA. Last word comes to you, Clint.
Yeah, we're talking about how to get the most of the TFSA here, and often getting the most of just avoiding some pitfalls. And
Yes.
that's one way to help out, and that's what we're doing today, is giving you a couple of those mistakes to avoid. We'll be back again very soon with another video, so everyone, stay tuned.